questrom is doing more in-person classes at other campuses.
No, yes. Okay.
I got this impression. I think because we have the technology.
Yeah, you guys have way better rules than any of the other schools.
Yeah. Let's hope that's a good thing for us. You know, I mean, it should be. We put a lot of investments into all this, so let's hope it works.
Yeah.
I can't see myself. I don't know why.
Camera's not on yet, so.
Oh, you know why? I know why. That's why. Hello? That's not right. Oh, here you go.
Yeah.
I'm just making sure that we have everybody. Why do I have a return?
No, that was me.
Oh, okay.
Yeah, I'm in person.
All right. Good morning. Happy Friday. Happy to see you guys. We're gonna get started soon. I'm still admitting a few people, but it's 11:17, and so we'll try to get started as soon as possible. Just a quick reminder, please be aware that we have again, like the homework are due this week. And also, I'm just checking on my calendar because I have to make sure that I show folks in the room here that I am clear to be in classroom. So please, guys, in the room, make sure that you do the same once you get situated. And so homework are due the 19th. Let me know if you have any questions, if you have any issues. Thank you. And if, again, you should be enrolled by now, and you should be able to go in and do the homework. One more thing that I wanted to mention is that about the homework, they're based on accuracy. Okay, so there's a question in the chat. You can unmute yourself if you'd like, Soima.
Hi, yeah, sorry. I was just asking, some homeworks in my lab are based on completion and some are based on accuracy for different classes. So I wanted to know what this one would be like.
So basically, what do you mean? So the idea is typically we set up the homework as such that you can retake the homework as many times as you want, as long as you do it by the due date. And then, of course, once you hit submit, it's going to be based on whatever you have submitted. And so you can still do homework after you are past the due date, but that will entail getting a penalty of 50% reduction of the points. Does that help?
Yes, it does.
Okay.
Thanks.
And for everybody, could you please mute your video? Again, it's already hard enough to be remote and not to have you guys here in person. And it's very important for us to have a sense of community we have to get used to this, and we'll try to get used as much as we can to this hybrid, but we have to all make an effort to be present. All right. So today we're going to get started with accrual accounting. Why don't we start talking about it, and then I'll do my little spiel on accrual accounting, so you guys can hear me giving you my 2 cents of words of wisdom on how to prepare, what to do, and so on and so forth. So, and I'm just making sure that my computer, here you go. Sorry. I have the technology of NASA over here, just making sure that I have all my bases covered in case I lose connectivity or something. So bear with me for a sec. Here you go. I'll have to. All right. So the idea is, again, we're going to start accrual accounting, chapter 3. And as usual, we'll talk about our little roadmap. We are looking at the financial statement construction, and this is the last block of financial statement construction, guys. So at this point, I have to pause. I've been a student too, and believe it or not, I'm still a student because I'm pursuing my doctorate I'm enrolled in a doctoral program, and the first 3 weeks of the semester are somewhat sort of getting adjusted, and never ever like this year we are trying to get adjusted. But please use next week if you need to catch up on catching up. If you miss these 3 fundamental concepts that we went through starting the beginning of the semester, not only you're gonna hate accounting, but it's gonna be extremely difficult for you to understand what we're gonna be doing. Do not believe, not even for a moment, that typically courses are like backloaded, front-loaded, and there's a way to predict that. This course is none of the two. It's somewhat like evenly spread out, and maybe I could say that it's like slightly backloaded because towards the end we try to look at more chewable, quote unquote, topics for you. But do not believe for a minute that you can pass these 3 chapters because you think like, well, that's the introduction, because you're not going to be able neither to follow me going forward. You're going to get very frustrated, and you're really going to hate accounting. So again, little advice. So let's get started. Let's talk about accruals, which of the 3 blocks, it's really the most complex. And again, it's the one that requires a little bit more thinking and a more critical thinking. So first and foremost, we need to differentiate between a cash and accrual basis of accounting. So financial reports based on all the transactions, like I can give you an example of why we have a disconnect here between cash and accrual basis of accounting, and why we start doubting about how do we book certain transactions. So in general, a given year, say 2020, performance is based on business transactions from January 1st to December 31st of that given year. So 2020 will be based on transactions from January 1st, 2020 to December 31st, 2020. 2021 performance will be based on business transactions from January 1st, 2021 to December 1st, 2021. The question is, what about transactions that start in 2020 and finish in 2021? I know here I have a picture that is happy and somewhat sad, because I don't think we're gonna have that new year in Times Square anytime soon. But the reason why we put a picture of the New Year's Day or New Year's Eve is because what happens at that point of cutoff? And I'm going to give you an example. I have a rent agreement that says I'm a company operating in Kendall Square, one of those, like Google slash any, like biotech companies that are in Kendall Square. And I pay a rent. Kendall Square is one of the spots with the highest rent in the United States. And in order for me to secure the rent, I prepay that rent and I get a discount. So it's convenient for me to prepay that rent. But my rent prepayment is 3 months starting November 1st, ending January 31st. So I have a transaction that goes across 2 years. At that point, I'm like, okay, I prepaid the rent. So I have a cash disbursement. My expense though, remember expenses, and we're gonna spend lots of time through this chapter to talk about that. My expenses though are based on the cost incurred. Well, I didn't incur the cost of the 3 months rent in November and December. I incurred the cost of 2 months. I have 1 month whose cost I haven't incurred because I haven't used it. Incurring a cost equals to use the resources that you purchased for your business. In this case, the quote unquote purchase is the rent. So the usage of the property. So with that in mind, that triggers a question like, how do I book these transactions? Because if I book 3 months expense in 2020, I'm going to be understating the net income of 2020 because in reality, I used just 2 months rent. And I'm going to overstate 2021 because I'm going to miss in 2021 1 month worth of rent. So how do I solve that issue? So this is what we're going to be talking about today. Transactions that really measure the passage of time and how do we deal with those depending on the accounting system used. And again, we'll refer to, there are different accounting systems, cash basis, accrual basis, modified accrual basis of accounting. The latter is typically used in the public sector or like very highly regulated sectors. Cash basis of accounting is not US GAAP and is used by very small businesses. And the one that we use for the most part, and the one that we're going to refer to during this course, is the accrual basis of accounting. Why am I giving you an example of cash basis? So that you understand, first of all, the differences and also the usefulness of the accrual basis of accounting. All right, so Big and Rich Hats LLC in 2020 buys hats from suppliers for a value of 165K, paid the 25K in 2020, balance on credit. So sells goods to a customer, the invoice value of 200K, receives 150 in cash in 2020, remainder to be paid in 2021. How should we report on this performance for 2020? So Big and Rich Hats buys hats from supplier for a value of 165K. 25K is paid in 2020, and the rest of the balance is on credit. So it's going to be an accounts payable. Sells goods to customers with an invoice of a value of 200K. Of that 200K, it gets 150 in cash in 2020, and the remainder is paid in 2021. So it will book an accounts receivable of 50K. How do we report that transaction? Well, let's see. I mean, it seems an easy transaction, but then we really need to look at the revenue and expenses of this transaction to get a sense of like, how do we report it? Because from a cash perspective, the cash is cash. But then how do I report the revenue and the expenses here? So there are two methods, and I'm sorry, I have to move on. There are two methods to answer the when, depending on the basis of accounting. The accounting basis, the cash basis of accounting, will book cash flow and revenue expenses recognition at the same time. So said differently, if I go back to my example here, like the accrual basis of accounting will book the cash flow, revenue, and expenses all at the same time. Whereas the cash basis of accounting, whereas the accrual basis of accounting will book the cash flow, revenue, and expenses at different times. Recognizing that cash can be exchanged at any point of time, but revenue and expenses will be booked when revenue is earned and expenses are incurred. So we're going to keep that concept in mind for the following slides. So again, but cash basis of accounting is very simple. Revenue is booked when cash is received. Expenses are booked when cash is paid. So extremely simple. But it's not very helpful to understand the performance of the business, because basically, what if I perform a lot of services and I don't receive the cash until the following year? Well, I'm going to book the revenue on the following year. So ignores the non-cash changes in economic circumstances, meaning like it really ignores when I have earned that money and guys, at this point of time, it might be difficult for you to understand the difference between earning and cash exchange, but earning in accounting means that you are entitled to book a revenue and you are entitled to be paid. Collection is when you actually get paid. So on cash basis of accounting, the result is incomplete because revenue, expenses, assets, and liabilities end up excluding very meaningful information that will be needed for you to book your net income. And it's again used only by smallest businesses, because in that particular circumstance, if we go back over here at the slide with the exercise, big and rich hats would have been able to recognize only 25K of expenses because that's what they paid, and recognize only 150 of revenue because that's what they received. Whereas we'll see under accrual basis of accounting, their revenue is 200K and their expenses are 165. So let's see how that works. Any questions so far? And again, for those of you that have the video muted, please make an effort to unmute your video. It's one of, the rules of the universities that we try to keep our videos on, so please unmute your videos. Again, cash basis of accounting is non-GAAP nor IFRS, which is the International Financial Reporting Standards, and therefore it's just used by smaller businesses. I mean, in my experience, I've seen it used only by a couple of churches, as very small nonprofit organizations, but other than that, I haven't seen it used that much. Accrual basis of accounting, on the other hand, the account records the impact of the business events and as they occur, regardless of when the transaction affects cash. Revenue is recognized when it's earned, and expenses when are incurred. I incur an expense when I use that expense. When I use a certain resource, remember, I use my resources into my production, into my daily activities. So I have inventory, that is a cost because I purchased it. that inventory becomes an expense as I use that inventory to sell goods. I have prepaid rent, which is a prepaid expense. We're gonna learn, and this is gonna be the most confusing thing ever at this point of time, that prepaid expenses are assets. I had a prepaid rent, which falls under the category of prepaid expenses of $60,000 to pay for the prime real estate in Kendall Square for 3 months, November, December, January. As I use the facility, my expenses incur. So the prepaid expense is a cost, but as I use that facility, I use the rent, I can book a rent expense into the financial statement. How? On a monthly basis as I use it. So let's talk about two pillars of accounting: revenue recognition and expense recognition principle. Which, by the way, what I'm describing right now is what is acceptable under US GAAP and under IFRS. So revenue recognition principle will tell you that revenue is booked when it's earned. So basically, if a business has to deliver goods or provide a service, then me providing a service as a lawyer is what triggers the revenue recognition. Not the fact that the client paid me. Okay? Then the client may pay me at a later date, but my revenue will be recognized as I go, as I provide the service. I'm sorry, that's what I meant. I'm not sure what happened. So first and foremost, you recognize the revenue when it's earned, and the amount of revenue recognized is what you expect to receive in exchange for the goods. So, for example, we're going to see this later on in the semester. If I sell equipment to make printers, I sell the plastic components to make the printer to Xerox or like any other kind of brand over there. So if I do that, Xerox is one of my main customers, and for each and every printer, the equipment, the plastic, actually, let's call it raw materials. The raw materials that I'm going to sell are, they cost $100 each to assemble a printer. Well, that's an outrageous price. Let's say $15 each. So, but because Xerox is my main client, I am going to give it to Xerox for $12.50. My revenue cannot be recognized for $15. It has to be for $12.50 because that's what I'm expecting Xerox to pay me. And again, we're going to go into details about this, but if you book a revenue for $15, then you're overstating your net income because you didn't make as much revenue. So, something to keep in mind. Again, the revenue recognition principle will tell you that revenue is recognized when it's earned. So when would I recognize the revenue for Xerox? When I deliver the plastic components, which is raw material for Xerox, to Xerox. Then whether the conditions of delivery may trigger the timing of the revenue recognition, which we're going to talk about later on, but it's like when you deliver. I'm a lawyer. I defend my client in court. I send the client a bill. When do I recognize the revenue, guys? Christian Vargas? Oh, you're,
Yeah, I'm good.
okay, you should probably put moderator there, because otherwise I'm gonna keep calling you, sorry.
Oh, okay.
Ikai, Ikai Luo,
Um,
anybody else? When do I recognize the revenue? I'm a lawyer, I have provided services, and I defended my client. I send the bill to my client, the client has yet to pay me. Thank you. When did I earn my revenue? Yes, Chunyu.
When you perform the service in court.
So, yes, I earn my revenue when I defended my client, so I'm entitled to bill the client. And at that point, I can book the revenue, regardless of when the client is gonna pay me. Expense recognition principle. Recognize expenses in the same period that related revenue are earned. So you need first and foremost to measure the cost incurred. Understand how much is my cost. I prepay rent for 3 months in Kendall Square. And, but I need to measure how much is gonna be the cost, how much it's $60,000 for 3 months. I have a big facility. So $20,000 a month. So I need to calculate, okay, for the month of November, the expensive current rent, it's gonna be 20,000. Same for the month of December, same for the month of January. So you need to make a calculation of how much is actually your cost incurred. And also identify the related revenue, when the related revenue are earned, recognize the expenses in the same period. What does that mean? I'm gonna make a very simple example here. Sale of goods. You book the revenue, and in the same period of time, so that you can get a sense of what's your cost of your margin, you book the cost associated with you making that revenue, which is the cost of goods sold. So you have your revenue and the expenses associated to that revenue in the same period of time, and that's called the matching principle. You always match revenue with expenses associated or instrumental for you to make that sale within the same period of time. Why do you do that? Well, imagine if I only book the revenue and I forgot to book the cost of goods sold, or I understate the cost of goods sold. What would happen to my net income? Again, I book revenue for 150. My cost of goods sold should have been 100. Instead, I book it to be 90. What happens to my net income? Yes, Anika.
You're overstating your revenue.
I am overstating my net income. I'm giving a false information to the stakeholders, to people that need to make decisions about my company. I am wrongly representing my earning per share, so my investors will be biased. Imagine. So this is a topic where people, like when I talk about people, I mean like accountants, management, puts a lot of emphasis on, because it's a risky business, not meeting the matching principle. All right. So let's go back to the exercise. Big and Rich Hats LLC buys hats from suppliers and operates company for $165. 25 paid in 2020, and the balance to be paid in 2021. Ships goods to customers for $200. receives 150 cash in 2020, the remainder to be paid in 2021. What did B&R, which is Big and Rich, give in trade? 200 of hats. What did he get it back? 150 cash and 50 in accounts receivable. What did it cost them to give the hats? How much it costed them? Yes. 165. So with that in mind, my 200 will be the revenue. My 165 will be the expenses. My net income will be 35. So basically 35 is much better reflection of B&R performance than what it would have been with cash basis, which is 125. Because on cash basis, what you would have done is, and I'm gonna go onto annotations and do it over here. What you would have done is, how much would have been the revenue? The revenue would have been 150. And because it was cash received was 150. And the cost of goods sold would have been 25. So you would have had a net income of 125. So that's why we use accrual basis of accounting. Reason being, you are distorting the financial statements like that. And obviously the performance of the company. Ooh, let me erase this as well. So does it make any sense, guys? I just want to make sure, because this is a very important concept. Okay. So again, when we talk, we always going to refer to the accrual basis of accounting. All balance sheet and income statements are accrual accounting for our purposes. Again, accrual basis of accounting gives business timely feedback on firm performance that is not tied to cash flow. Acknowledges that firm value can change without changes in cash. Because ultimately, what you're trying to do, guys, is really look at the value of the company. Look at like what is that I need to again to create value of my company. By value of the company, we think about the income, like how much profit and how much expenses in the company can actually produce, and how much added value to the equity, because remember, the retained earnings is going to be the bucket where the net income goes. How much of that it's going to be given by the company, by the performance of the company. So that's something to keep in mind, and something to reflect on, because especially at this stage, you might be tempted of thinking that it's all cash basis. And this is not unusual, because I've seen tons of students, again, making this assumption. So let's just, again, let's just get used to the fact that the accrual basis of accounting is the way we're going to think about recognizing revenue and expenses. So, and again, one more time, unless you're told otherwise, always assume that in this course, we are referring to the accrual basis of accounting when we talk. There's no such a thing as a cash basis of accounting. So, accrual basis of accounting is the theory we use based on exchange, not when cash is paid, based on value exchange, not on cash paid. How do we keep track of all this? You can't just look at the bank statement. You have to do the so-called adjusting entries. Adjusting entries are going to be a specific categories of entries that we are going to be going over this chapter. We'll do it next week, because we are not going to have the time to do it this week. It's just we have to go first through the exercise of understanding where do we have an accrual, when is that we have to book the adjusting entries. And then from there, we'll then build a sense of like, okay, for certain specific transactions, we will need an accrual. For some other transactions, we won't need them. So, all right. One other important concept before we move on and we do a little exercise is the concept of cost. So at this point, you guys typically consider cost equals expense. Not necessary. We use typically like when we talk, we use them interchangeably, but there's a slight distinction, which becomes an important distinction as we look at from an accounting perspective. Company incurs a cost. So I incur a cost to buy inventory. And then I incur a cost to pay my utility bill. The inventory is what kind of account, guys? Assets, liabilities, equity, revenue, or expenses? What is inventory? Yes, assets, and Ching Yun is saying assets too. What about the utility bill? Is that an asset? Remember the concept of assets. Assets are resources that will benefit my business in the future. The utility bill of questrom, once I pay it for the month of September, has no benefit in the future, because unless I pay the bill in October, the utility company will shut down my electricity. So I incur a cost, but one is an immediate benefit and the other one is a benefit over time. If the benefit for current periods, that cost is reported straight as an expense. If the benefit is an extended benefit in the future, such as the inventory, that cost becomes an asset, becomes a capitalized cost, and is reported as an asset in the balance sheet. And then as I use it, it becomes an expense, reduces the asset, and it becomes a cost. Inventory, as I use it, what kind of expense it becomes, guys? Samantha? I'm trying to make sure that I hear from everybody. Samantha, are you there? Okay. Anybody else? What kind of expense becomes the inventory as I use it? Yes, Shane.
Does it turn into cost of goods sold?
Absolutely. It becomes cost of goods sold. Thank you. So, transactions versus adjusting entries. Transactions with external parties are recorded when physical events occur, and those are most of the transactions. Adjusting entries, on the other hand, are needed when income statement affects a transaction and is recognized as the time passes. For example, the transaction where I have to book the rent expense. As the time passes, I book that rent expense. So in an accrual, the cash transaction follow the income effect. So in a situation where I talk about accruals when I first recognize the economic event, so the expense, and then I have the cash transaction. I talk about a deferral when I first have the cash event and then I have the economic event. Let me make an example. If I have to pay interest on a loan every 3 months, at the end of the quarter, I use the cash throughout the 3 months, throughout the quarter. So that means that interest is instrumental for me to use the cash. Therefore, I recognize an accrual for the quarter, for a third of that interest expense on a monthly basis. That then will lead to get the full interest expense for the amount that I have to pay at the end of month 3. And after that, I will pay, like at the beginning of the following quarter, I pay that expense. Another example is payroll expenses. If I have a payroll cycle that it goes across 2 fiscal years, with 1 week in December and 1 week in January, I will pay that payroll sometimes in January. But the employee worked for me and I incurred the cost of, paying that employee for a week in December. So I will accrue for that expense, and the cash transaction will follow the income effect of me booking an expense for 1 week of work of that employee that year. The pearls are the opposite. Say the prepayment of the rent just to get a better price. The transaction, the cash happened first. And then meaning the cash transaction. And then as I go by, I will book the expense, which will give me an income effect which is reducing the income. An adjustment to prior accrual or deferral is basically the adjustment in the financials that will show me the passage of time, that will show me, okay, how much of this income and this expense I have to book based on how the time is passing, how many months are passing for the rent, how many months are passing for the interest expense, when is my payroll cycle ending. So with that in mind, I have put onto the question tools a few transactions. I'm going to use the next few minutes to talk about these transactions so you can and try to classify them. So I'm going to switch here and hold on 1 second. What did I do? Okay, I'm going to share it with the document camera as usual. And again, feel free to, please do the exercise for Monday on your own so we can go by, we can sort of look at the exercise together on Monday. All right, so you should find on question tools this handout. Here you go. All right. So first transaction, and this is going to be easy enough that really we can go, we can just go around and ask people to participate. So transaction number 1, issue common stocks for cash. I'm planning, let's try to go pretty with a fast pace on this. Yachting. What do you think is happening here?
It's like For assets goes up.
I'm sorry, do you mind to speak up? We can't hear you.
Can you hear me right now?
Yes, thank you.
Um,
So assets go up by how much?
9,000.
9,000 cash. And then somebody else, Shuhong, what happens to the other side of the transaction?
Equity goes up 9,000 as well.
Equity goes up because of common stocks by 9,000. So I would debit cash and I would credit common stock, debit, credit by 9K over here. And then 9K here and 9K over here. Easy. All right? So in your handout, what you'll need to do is use the debit and credit. Number 2. And I'm going fast on that transaction because I mean, week 3, that transaction should be something you should be able to do blindfolded. On February 1st, 20x2, Red paid 24 in advance for the next 12 months for rent. So I'm gonna give you here prepaid rent, which is a prepaid expense. Okay? Prepaid rent is an asset and it's gonna be for 2,400. What else happens here? Rent paid. So what's the other account that I'm gonna be using?
Cash goes down.
Cash goes down by 2,400. So prepaid rent will go up by 2,400 and cash will go down by 2,400. Therefore, here, my cash will have a decrease of 2,400 and my prepaid rent, well, this was 9,000 to begin with, and then my prepaid rent will go up by 2,400. And so this will be 6,600. Okay? Now, what is this transaction where I have the cash event happening before the economic event over here? Is it a deferred revenue? In a deferred revenue, cash is exchanged before the revenue. Is it a deferred expense? Cash is exchanged before the expense. Is an accrual? Revenue is recognized before cash, is an accrued revenue, sorry, or is an accrued expense? Expense before cash. Is depreciation or none of the above? What do you guys think that is on this category?
Cash before expense.
So it's a deferred expense. Okay? For which we'll need to make an adjusting entry. All right. Transaction number 3. On March 1st, 20x2, Red paid 1,200 of office equipment. The office equipment is expected to have a 4-year useful life and no salvage value. So it's a long-term asset. So I'm going to have cash for 1,200 and equipment, which will go down, and equipment, which will go up. What do I debit? What do I credit, guys? Dylan?
You credit the cash and debit the equipment.
That is correct. And so I debit the equipment for 1,200 and I credit cash for the 1,200. Now here I had 9,000 minus 2,400 and then minus 1,200, which will bring me to 5,400. And then here I have a beginning balance of 1,200, like equipment for 1,200. So going back here, is this transaction a deferred expense or an accrued expense? What do you guys think? Martin?
Maybe cash before revenue because you'll use the equipment to earn revenue.
So yes, you use the equipment for the revenue, but everybody agrees on that? When you're gonna use that piece of equipment, you're gonna have an expense. You're gonna depreciate that expense. So it is actually a deferred expense, guys. Okay? Which then will trigger a depreciation. Number 4. Number 4, and this is gonna be our last transaction. On April 1st, 20X2, RET receives 6,000 for services that will be provided by RET during each of the next 12 months. So RET received 6,000 cash, which will, for services that will be provided by RET over the next 12 months. Samantha, what happens to cash? Fundu, what happened to cash? Anybody else?
Cash
Oh, yeah.
goes up.
Cash increases by 6,000. And then we're gonna introduce a new concept, the concept of I have provided services. I'm sorry, I haven't provided services, but I received money. So I owe the client the service. So I owe somebody something that's a liability. And we're gonna talk about an account called deferred revenue, which is a liability account. Because I got cash, but I haven't provided the service yet. So if at some point, at the end of the fiscal year, I have an obligation to provide services. So that would be for 6,000. Therefore, my cash gets debited by 6,000 and my deferred revenue gets credited by 6,000. So in here, guys, I'm gonna have 6,000 increase and deferred revenue will be 6,000. So we will stop right here at transaction number 4 and we will continue next class. So I would encourage you guys to go back, major takeaways. You know, you're gonna find this slide. Please review this slide. You're gonna find this slide on your package, and also please make sure that you kind of familiarize yourself with the idea that there are, like, major takeaway here is that there's a passage of time that brings certain transactions starting in one fiscal year and ending in the following fiscal year. And so we need to deal with those. Thank you very much. Samantha, may you stay for a second, please? Thank you. I know you have to run to class. Sorry about that.
Thank you.
Thank you.
Thank you.
Thank you.
Thank you. Samantha? Samantha? Thank you, bye. Samantha? Samantha?